Hey everyone, in today's video, let's discuss one of the option strategy, short strangle, in a very simplified way. We are now at tradingview.com. Let's open the chart for Nifty 50. Okay, now let's look at the data starting from 9th of December onwards. Here it is. If you carefully see, market was completely in the range bound state during this entire week. It was relatively stable. So this was the point where we could have implemented a strategy like short strangle. Let's have a quick demonstration of it using stock mock. Okay, now what we will do is we will create a strategy on 9th of December. We will hold it throughout the week and see what were the results. Let's say we create this strategy at 9:30. So at this point of time, the Nifty spot was trading at 24,664. Now when we create a strategy like short strangle, we need to sell out of the money call and the put option. So basically we are doing a naked option selling over here. This is the option chain that you see. So the at the money price is at 24,650. Let's sell a 24,400 strike at the put end and a 24,900 strike at the call side. So this is the payoff graph for short strangle. Here the estimated margin is 80,000. You make a limited profit of 4.7% compared to the loss, which is undefined. Your probability of profit is 64%, and you have a break even of minus 1.7% at the downside and 1.6% at the upside. Let me run this strategy throughout the week and see what were the results. I'll do it a little quick. Now whenever you sell an option, you collect the premium. The premiums you collect can be your profits only if the option expires worthless at the time of expiry. Yeah, so we've almost reached the end. Yes. So at this point of time, the spot Nifty price was at 24,545. We have made a profit of 3.6%. Now if you see the put and the call leg, which we sold at 74 and 75, have now been expired worthless, and we have pocketed the entire premium. Interesting, right? So we have an advantage over here. We need to be pretty clear whenever the market is in range bound state, since we are betting on low volatility and it's a neutral strategy. Now let me just clear this. Now let's look at one of the interesting thing. If we look at the data a week prior to 9th of December, here it is, starting from 2nd of December. If you see, the market was completely in the uptrend. Now what happens if we deploy the same strategy during this week? Let's demonstrate it as well. Now we will create a strategy on 2nd. We will hold it throughout the week and we'll see the results at the day of expiry. So let's create a strategy on 2nd of December at 9:30. The Nifty spot is at 24,033. The at the money strike is at 24,050. So we sell a 23,800 put and a 24,300 call. Yeah, so this is the payoff graph again. 80,000 is the estimated margin. The profit is limited to 3.7%. The loss is undefined. The probability of profit is 65%. We have a break even of minus 1.5% at the downside and 1.6% at the upside. Now let me just manually run this. As you see, since the market is trending upwards, the probability of profit is decreasing and the break even at the upside is also decreasing. Yeah, see, on Tuesday the break even at the upside is 0.0% now. The probability of profit has dropped below 50%, right? Now let me just auto run it for rest of the days. Yeah, we have started entering the red zone. We've reached at the time of expiry. So at this point of time, the Nifty spot is at 24,704. we have ended up in the red zone. We have made a loss of 6.2%. Now if you carefully see at the put and the call leg, the put leg we have sold at 62 as expired worthless, so we have pocketed the entire premium. But on the call side, the leg that we have sold for 53 is now worth 409 rupees, so we have made a loss of 663%. Also, if you see in the option chain, the call option which was out of the money on Monday has now turned in the money at the day of expiry. So there are certain disadvantages also for this strategy. First one, the reward is limited whereas risk is unlimited. You require a very high margin to deploy naked option strategies, and you constantly need to monitor the strategies into the real-time market. A sudden uptrend or a downtrend can crush your capital. So in order to minimize your risk, we have an advanced version known as short iron condor, and we'll talk about that in the next video. So guys, that's it for now. I hope you like the content, and thanks for watching.